I'm going to be straight with you. Before I started researching this video, I had no idea how good Palantir's business actually was. Most Palantir content is either this stock is going to the moon or it's massively overvalued. I don't own it. I have no position. So let me just show you what the numbers actually say. Here's what caught my attention. The stock is sitting around $130, down 37% from its 52-week high. But the business just posted 137% commercial revenue growth, 43% GAAP net income margins, and a Rule of 40 score of 127. The best software companies in the world aim for a Rule of 40 score of 40. Palantir is at 127. So here's the question I kept asking while doing this research. If the business is this exceptional, why is the stock down 37%? By the end of this video, I'll give you my honest answer to that, and I'll tell you exactly what would get me to buy Palantir shares, and what's keeping me from doing it right now. I'm not here to tell you Palantir is going to the moon. I'm here to break down the business and let the numbers do the talking. But first, we need to understand what this company actually does, because most people still have the wrong picture. Here's the version of Palantir most people still picture. A secretive government contractor connected to Peter Thiel, helping spy agencies track terrorists. And yeah, that used to be the story. It's 3 years old. Palantir runs 3 products. Let me break each one down in plain English. The first is Gotham, the original government platform. Yes, this is the spy operation. It lets military analysts and intelligence agencies connect massive amounts of data into a single operational picture. Counterterrorism, 20 years of deployment, including a 10-year Army contract worth up to $10 billion. Gotham is stable, growing 66% year over year, and it's the foundation that kept Palantir alive long enough to build what matters today. The second product is Foundry, basically Gotham for corporations. It breaks down data silos inside companies and gives every department a single view of operations in real time. BP uses it for energy production, American Airlines for fleet management. One telecom company started working with Palantir in 2022 and has increased their contract 10 times since then. But here's where it gets interesting. The third product, AIP, the artificial intelligence platform, is why US commercial revenue is growing 137%. AIP connects large language models, same underlying technology as ChatGPT, to a company's actual data and operations. But it's not a chatbot that writes emails. It's AI agents that do real enterprise work. Citibank reduced customer onboarding from 9 days to seconds. Fannie Mae cut mortgage fraud detection from 2 months to seconds. Nebraska Medicine saw a 2100% increase in hospital discharge utilization. Now, why can't OpenAI or Google just do the same thing? This is where Palantir's real moat comes in. It's called the ontology. Think about it this way. Most companies have data locked in separate filing cabinets that don't talk to each other. HR has one system, finance has another. Operations has a third. Palantir's ontology is like installing a central nervous system that connects all of them in real time. Raw AI models are brilliant, but they're dangerous in enterprise settings. They hallucinate. They make catastrophic errors in high-stakes workflows. CEO Alex Karp said it directly. LLMs, on their own, are at best a jagged intelligence divorced from even basic understanding. The ontology is what turns that jagged intelligence into something safe enough to run in a hospital or a military command center. Palantir spent 20 years building it. That is the moat. And here's the last piece most people miss, the sales model. Traditional enterprise software sales takes 12 to 18 months of demos and committee approvals. Palantir eliminated that. They run boot camps, 2 to 5 day sessions, where a prospective customer works with Palantir engineers on their own real data and builds working use cases in days. A healthcare company completed a boot camp in April 2025. They signed an $88 million contract 30 days later. You don't say no to software you've already seen. Save your hospital real money. The business model is clear. Now let's look at what the actual growth numbers show. In full year 2025, Palantir did $4.5 billion in revenue, up 56% year over year. But that headline actually understates what's happening, because the US commercial business is doing something extraordinary. In Q4 2025, here's the segment breakdown. Total revenue was $1.4 billion, up 70% year over year. US government was $570 million, up 66%. And US commercial was $507 million, up 137%. 137% for a business that was generating almost no commercial revenue 3 years ago. The customer data backs this up. US commercial customers grew 64% year over year to 485. Total customers crossed over 1,000 in Q1 2026. And net dollar retention hit 150%, meaning existing customers are spending 50% more every single year. For 2026, management is guiding $7.2 billion in total revenue. U.S. commercial alone is guided above $3.1 billion. That's another 115% growth rate in a single year. But here's what surprised me even more than the growth: what this company actually does with the money it earns. The rule of 40 is how the industry measures whether a software company efficiently balances growth and profitability, ad revenue growth rate, and profit margin. Best software companies aim for 40. Palantir was at 94 in Q2 2025, 127 in Q4, 145 in Q1 2026. Most elite software companies score in the 60s and 70s. Palantir is at 145, 84% gross margins, 43% GAAP net income margins, 56% free cash flow margins. In Q1 2026, Palantir generated $925 million in free cash flow in a single quarter. And here's Alex Karp's own words from the Q1 2026 earnings call. Our free cash flow this quarter is larger than our revenue a year ago in the same quarter. Let that land. Balance sheet, $8 billion in cash and treasury securities. Essentially zero debt. Current ratio of almost 7. This is one of the most profitable and most well-capitalized software companies on earth. If you're finding this breakdown useful, hit subscribe. I do one of these every week. Now let's get to the part that makes this stock genuinely complicated. Here's where the honest investigation gets uncomfortable. Because as exceptional as this business is, the valuation is pricing in perfection. Trailing price to earnings ratio, 146 times earnings. The software industry average is 27 times. Even among AI premium peers, the average is 67 times. Palantir is at 146. So what does the math say has to be true to justify this price? To reach a reasonable exit multiple by 2030 at current prices, Palantir needs to sustain approximately 53% earnings per share growth compounded every single year. Not 1 or 2 great quarters, 10 consecutive years of near-perfect execution at a scale almost no software company has ever delivered. The forward price-to-earnings ratio drops to 62 times based on 2026 earnings guidance. That's still expensive, but it's a very different conversation than 146. The analyst range reflects this uncertainty. Bear case valuation model, $107. Simply Wall Street's model, $145. Median analyst target across 85 analysts, $152. Bull targets from Wedbush and Citigroup, over $230. The market believes in this business. The debate is whether it should believe this much. Now here's the part one I want you to pay the most attention to. I've shown you everything that makes Palantir look exceptional. Now I owe you the same honesty on the other side. In the last 6 months, 334 insider sales, 0 purchases. Peter Thiel, co-founder, $289 million in a single month. CEO Alex Karp, $128 million. CTO Sankar, $115 million. President Cohen, $110 million. These are the people who built this company. They know it better than any analyst on Wall Street. And right now, not one of them is buying a single share. Yes, most of these are pre-planned selling programs, and Vanguard added nearly $1 billion worth of shares in the same period. But the insider signal is there. I think viewers who trust this channel deserve to hear it flat and make their own call. Second concern, international. International commercial revenue fell 3% year over year in Q2 2025, fell 5% in Q1 2025. A UK parliamentary committee designated Palantir as an unacceptable point of weakness. The NHS contract came under review over data privacy. Management has quietly shifted their language from aggressive international expansion to targeted opportunities in Asia and the Middle East. If Palantir can't scale outside the US, their total addressable market has a hard ceiling. Third, in May 2026, HSBC downgraded Palantir with a specific warning. OpenAI and Anthropic are copying their playbook, building forward deployed engineers and pushing directly into enterprise. Their note said some of Anthropic's growth may be coming at Palantir's expense. Karp now calls his competitors token maxers. That's a defensive posture. And finally, stock-based compensation, $684 million per year. The share count grew 14% in 4 years. That's real dilution that real shareholders absorb every year, even as GAAP income is now positive. One more blind spot worth flagging before I give you my verdict. Palantir never reports gross customer retention or churn. Net dollar retention of 150% sounds great, but it doesn't tell us how many companies pilot AIP and walk away. Management acknowledges this gap but doesn't fill it. For a company whose entire commercial growth story depends on AIP adoption becoming permanent, the absence of that data matters. After all of these numbers, here's where I land. What I like, the business is exceptional by almost any measure. Rule of 40 at 145, 56% free cash flow margins, $8 billion in cash and zero debt. US commercial growing over 100%. A bootcamp sales model that closes $88 million deals in 30 days. A product moat that took 20 years to build. And a government contract base including that 10-year, $10 billion Army deal that isn't going anywhere. What concerns me? The valuation demands a decade of perfect execution that almost no software company has ever delivered. 334 insider sales and zero purchases from the people who know this business best. International commercial revenue is in decline, not a one-quarter blip, but a trend. And the competitive threat from OpenAI and Anthropic is documented, not theoretical. And here's my condition for buying. If I like the business enough, and I do like the business, I'd be fine just buying shares. No options play needed here, but my condition is this. I want to see 2 more quarters of U.S. commercial growth above 100%, Q2 and Q3 2026. If that holds, the AIP adoption story is real and this business has earned its multiple through growth. If it decelerates even to 60 or 70%, which would still be remarkable, the multiple will compress, and there'll be a better entry. I'm not here to tell you Palantir is going to the moon. I came in with no position and no bias. The numbers told me exceptional business, expensive valuation, real risks on the edges. That is a watchlist stock for me, not a buy today. I'll be watching Q2 2026 earnings on August 10th. If U.S. commercial holds above 100% growth, I'll be back with a buying video.